Hello, my name is Luis Oganes. I'm the head of FX, Commodities and Emerging Markets Research at JP Morgan. I'm joined in this video by Joyce Chang, a Global Head of Research, to discuss the global economy and the outlook for 2019. So Joyce, we spent most of this year wondering, what is driving this divergence of trends in growth, with the US outperforming and the rest of the world underperforming. Looking into 2019, do you think that this US versus rest of the world dynamic is going to continue, or we're going to see some kind of reconvergence of growth?
Well, the current U.S. expansion is destined to become the longest in post-war history, and it's just shy of the longest uninterrupted expansion since 1860. So we do see growth slowing in the U.S. We see growth coming down from around the 3% that it's been at to more like a 1.9%, and more of a synchronization with the rest of the growth cycle. But we're still looking at above-trend growth for next year at 2.9% for the global economy, despite all of the concern about a rising recession risk.
This year has been full of surprises. Some of them, purely economic. Several of them geopolitical. Again, looking into 2019, what do you think are the key risks for the global economy?
I think the market will remain very focused on the trade tensions between the U.S. and China, but trade tensions overall. So markets will very closely watch the negotiations that are going on. Is it a 90-day hold, or is there a greater resolution that's in sight? And the concerns will be about, will China slow down in growth? I mean, every 1 percentage point drop in Chinese growth, we think, takes 0.5% off of global growth. So I think U.S.-China will be one of the key issues that will remain on the table carrying over until next year.
Certainly, that is probably one of the top geopolitical concerns. Others that come to mind when watching the outlook for next year?
Brexit. And Brexit, we would just say that is a longer-term issue. We see this as an ongoing discussion that's going to go up until the UK elections in 2022. But we have raised the probability from 20% to 40% for no Brexit, and the decision to delay the vote points to the fact that there's still a lot of moving parts in the whole Brexit discussion. But the rise of populism more broadly is also, I think, going to remain an issue as we look at the transitions in some key emerging markets countries, particularly in Mexico and Brazil.
So in the case of emerging markets, we do have this deceleration next year going from 4.8 to 4.4%, but a lot of that, interestingly enough, is predicated on the slowdown that we expect in China. For the rest of emerging markets, is a moderation of growth from 3.3 to 3.2. There is, however, this huge issue with respect to what the Fed does and what that implies for capital flows to emerging markets. So the market seems to be a little bit all over the place these days, pricing out actually the likelihood of hikes next year. What do you think will happen?
Well, we still have penciled in 4 Fed hikes for next year, and we think the next move is still a hike. But it's very data dependent. So I think it's hard to call the full year at this stage in the game. It will depend on how the data is playing out. But we do think that Fed policy could become restrictive by the second half of 2019. And if they do continue to move, we would expect that the curve would invert sometime in the second half of the year.
Well, certainly that doesn't bode well for the outlook for capital flows to emerging markets.
Well, it's tighter financial conditions overall, which will hit all credit markets, but also emerging markets. So, last year we had a year of record inflows, and we started the first quarter with what looked like it would be on track to be another very strong year. But we've seen outflows since April, and the question is, will we actually see outflows from emerging markets next year that could be in the order of as much as 30 billion or so?
Well, certainly, when we discuss emerging markets, looks like this year was driven by a lot of disappointment during the course of the year. Next year, it looks like it's going to stabilize a bit, but there may not be enough time for emerging market assets to do well in an environment where the Fed, as you said, could tighten up to 4 times.
Well, I think you had a lot of surprises in the past year in emerging markets, whether it was Argentina or Turkey. So I do think that you probably have seen a bottoming of growth ex-China. So China remains critical in the whole question, but we would expect emerging markets growth to stabilize. And we still look at the financing needs as being very manageable. And you have attractive yields compared to other credit markets in emerging markets. So there are definitely some tactical opportunities there.
And we're certainly not calling for a crisis of sorts. Certainly, a lot of the questions that are asked, are we going to see another Argentina, another Turkey in emerging markets? We're not calling for that, right?
Oh, I really don't see that as being a likely scenario for 2019. I think the story is more one of stabilization. I also think that China has also given the signals that they will use policy stimulus as they need to, whether it is some combination of a fiscal stimulus and also allowing the currency to depreciate as they have before. So we don't see China's growth going below 6%. We think that they can stabilize growth in China, that some of these fiscal impulses will play through. So I don't think that you're going to see that much more downside play out in the emerging markets, given the low base that we're coming from.
Joyce, thank you for joining me in this discussion, and thank you all for watching this video. Please stay tuned for further updates on the global outlook at jpmorgan.com.